Hey everyone, what's up? Richard here, and in this video I want to share with you a financial hack that made me a millionaire by 30. Now, in case you don't know who I am, my name is Richard Norris. I've built a multi-million pound property portfolio, and I've helped over 300 clients build successful property portfolios too. Now, I've done over 1,000 consultations with clients, high net worth individuals, business people, corporate employees that earn £250,000 plus per year. And equally people at the other end of the spectrum that make only say £50,000 per year. However, there's a fundamental financial literacy problem that I noticed that most people have. And this is the main reason why people stay where they are. Ultimately, there's an equation that goes like this, and I have a meme, and it goes, it doesn't matter how much money you make, it's only important how much money you keep, and out of the money that you keep that you can multiply. Now, from my experience, having worked with over 300 clients, having spoken to over 1,000 people on sales calls, when I look at their situation and their financial situation, this is the thing that shows up all of the time, and this is the thing that keeps them really in the middle, in the lane of the middle class, working in a corporate job, paying into a pension, and never, ever achieving long-term sustainable wealth and never becoming financially independent. And here's why. So let's say, for example, that you're somebody who owns a property. So we have a property here, right? Now, in our property, we might have equity. Now, in this scenario, I'm going to say that this property is worth £500,000, okay? So the property is worth £500,000. And let's say that on this specific property, the mortgage is just £200,000, right? So in this example, we have £300,000 of equity, right? Now, on this property, the £300,000 of equity sits in here, and we have the £200,000 mortgage over here. Now, on this £200,000 mortgage, we have to pay monthly repayments, right? Now, on this mortgage, let's just say, for example, that this mortgage costs us £1,000 a month in monthly repayments, right? Which is effectively £12,000 a year. Okay. Now, in this example, what we're saying is that we've got £300,000 tied up as equity in our property, it's actually costing us £12,000 a year to keep it there. Now, what people typically don't see, is that this £300,000 in their property is actually tax-free money, okay? So all of the money that you've used to pay down your mortgage over the years has usually come from earned income that's been taxed. And this is the biggest problem that keeps people basically stuck in the lane of the middle class and not being able to become financially independent, is that they don't quite realize this. And I didn't either until I started to learn financial literacy and really started to study it at the granular level. And this is what I want to share with you, because hopefully it might help you. So £300,000 in the property that's tax-free money, costing us £12,000 a year to keep it there. Now, the biggest problem is that, let's say that this person over here, right? This person over here works in a corporate job, and let's just say that they earn £100,000 a year, right? So they're a higher rate taxpayer. And even if you're watching this video and you earn less than £100,000 a year, even if you earn 50,000 plus, anything above 50,000, you're going to be a 40% higher rate taxpayer anyway. So for the purpose of keeping this simple and helping you to understand it, I'm not going to take off any national insurance contributions and all of those things, and I'm not going to allow your personal allowance that you get every year. I'm just going to say on the £100,000, we pay 40% tax. So that's 40,000 in tax, which means that we only keep £60,000 from our job, from our earned income here, right? Now, we go to work every day spending 40, 50, 60, maybe even 70 hours a week working, trading time for money to be paid £100,000 of earned income. And on that earned income, we only keep £60,000 of it, okay? We give £40,000 away to HMRC and taxes, right? Then we use that £60,000 to go and service tax-free money. So we're using taxed income to service this tax-free money up here of £300,000. And we go around in this cycle, in this monotonous cycle of working to earn the 60,000 to then pay the 300,000, to then service the 300,000 pounds of earned income. Now, in this scenario, this 300,000 pounds is costing us money. And not only that, this money isn't making us any money. It's not making us cash flow every month. Now, most people think that their own home is their greatest asset in their life. And actually, when you learn financial literacy, you will learn that your own home is the biggest liability that you have, because the definition of an asset is something that gives me money every month, something that pays me every single month. The true definition of a liability is something that costs me money every month, right? So actually, if we term this debt that we've got over here of £300,000, I would actually term this as what I call bad debt. And the reason why it's bad debt is because it's not making us money, it's taking us, it's a liability, it's costing us money every month. Usually for most people in this scenario, and even if you're a business owner, typically speaking, on your personal balance sheet, your monthly mortgage repayments are the biggest monthly outgoing and expenditure that you have. And this is the problem. So in this scenario, 300k costing us £12,000 a year. We earn £100,000 a year, but we're only keeping 60,000 of it. And we're using our hard-earned income that's taxed at 40% to then service tax-free money. So it just doesn't make any sense, right? When you look at it like this, you can see that this financial roller coaster of how we use our money is keeping us trapped. We're on this monotonous cycle, and it's like we're on the treadmill and we can never get off. And the only reason is because you're actually earning good money, £100,000 a year, not a bad salary. But the reason why you may think or may resonate that potentially you should or could be having more in your life, earning £100,000 a year of income, is just because the way you're using your finances, okay? Now, so you might be thinking, well, what can I do then? What can I do in this scenario? Well, what you can do in this scenario is you can actually do something much better. If you take this £300,000, so remember we had our property over here that had £300,000 of equity in it, what we can do is something called an equity release. And a lot of the clients that I work with, and including myself, I also did this too, to help me expand and grow my portfolio. And the way to do this, and this is going to teach you the new financial habits and the new path, this is really how the wealthy think, okay? You've got £300,000 in your own home costing you money. What you can do is you can release equity, okay? Now you can take this equity out in a number of ways. You can release the equity against your salary. And typically speaking, you can borrow 4.5 times your salary. So in this scenario, if this person was earning 100k for the example, they could borrow 4.5 times this salary on a mortgage. So they could effectively leverage up to £450,000 on this property. Now, if they did that, they're going to be at a 90% loan to value, okay? Because remember, the property price was £500,000. And in this scenario, they can take 450,000 out against it. So they keep 50k of equity in the property, and they actually release, what they do is they release £250,000. So you take £250,000 out of this 300, okay? And you just leave 50k in there. Now, how does that calculation work? If you're following this video and you're thinking, well, how did I get to that point? Basically, what I did is I took the £450,000 from here, which is the new borrowed money, and I paid back the £200,000 mortgage that I owe up here on the property, okay? So if I take 450,000, which is my new mortgage, and I minus the 200,000 on my property, the mortgage that I owe back, that gives me £250,000 that I can take out in cash from this property, okay? Now, in this scenario, it basically means now I've got 50k in my property, I've got a 90% loan to value on my mortgage on a £500,000 asset, right? But I've got £250,000 of cash out. Now, what I can do with that cash is I can set up a property business called an SPV, and in this SPV goes £250,000 of that cash. That cash goes into the SPV as £250,000. This is effectively a limited company, okay? So without going into the granular details of what an SPV is for the purpose of this video, it's just a limited company, right? Now this £250,000 that goes into the company, so we've got our SPV here with £250,000 in it. This £250,000 can be invested to buy properties. And let's just say, for example, we buy 5 properties, okay? So we buy property 1, 2, 3, 4, and 5. And all of these 5 properties, therefore, have a deposit of £50,000 in them. But each of these properties that I'm buying makes me make me individually, let's say they make me each £500 a month, right? Net cash flow. Now 500 times 12 is £6,000 a year from each one. And I've got 5 properties, so that's £30,000 a year that my £250,000 is making me in this example. Now, if I do £30,000, and I divide that by the £250,000 and I times that by 100, effectively in this example, this £30,000, up here, this £30,000 is making me a 12% return on my capital. Okay. Now, this money, because this money up here, this £250,000 that went into the SPV, went in as what we call a director's loan account. It went in as tax-free money, because the money that we take from property when we do an equity release from our own home is tax-free money. Okay. Now, the reason it's tax-free money, again, is because that money has been taxed at source. Again, you've paid down your mortgage, you've accumulated equity in your own home by using earned income, which is taxed at source to pay for your mortgage. So when you take that money out, it's not going to be taxed again because it's already been taxed at source. So what we do is we take that money out, the 250,000, we put that money into the SPV, okay, into the property company, and we put the 250,000 in there, and it goes in there as a director's loan account. Now, because we invested the 250,000 as a director's loan account in the business, and we didn't buy the property in our own name, that money can come out again from the property tax-free. So this £30,000 up here that we're making every year is tax-free money. Okay, that £30,000 can come out of the company every year, and you can pay yourself £30,000 from your cash flow from your properties into your personal name, completely free of taxes, alongside any other income in your life. So even if you're earning £10 million a year in personal income, this £30,000 would still come out of your property portfolio tax-free. Okay, and that's a huge advantage. Now, you can see with that tax-free money, what we can actually do is the £30,000, right, pays back our mortgage on this property, right, on this property here, on our own home. It pays back our mortgage here. Now, remember, in this scenario, we took out a mortgage of £450,000. So effectively, in this new property over here, in our current property, but has an increased amount of mortgage on it, so it has 450k of mortgage instead of 200. So effectively, maybe our mortgage payments went from £1,000 a month to, let's say, £1,500 a month, which is costing us therefore £18,000 a year to service. £18,000 a year of mortgage repayments. Well, what we can do is we can take the £30,000 that we earn from our properties, and that can pay back this £18,000 a year. So 30,000 pays back the 18,000, and remember that this £30,000 is money from your property portfolio. Therefore, your assets, your properties, are paying for your liabilities, your mortgage, and you're making money on top. Okay, and this is the way to get your money working hard for you, because this 30,000 pays back the 18,000. We're left with a profit of £12,000 a year of profit, of extra income in this situation. We still live in the same home, but we're actually £12,000 up because we're not using the money from our earned salary to pay for the mortgage. Actually, we're more than £12,000 up the time we take off the taxes. But for the purpose of this video, and for trying to keep things as simple as can for you to help to understand how to kind of recreate your balance sheet and learn financial literacy to use your money in a different way, you'll see that in the same position you're in today, if you just used your money in a different way and thought about money in a different way, you would be financially independent very quickly, and you'd start to build long-term wealth with that one financial habit and that one financial hack. So let's compare the two examples just to summarize for clarity then. So in the first example, you had 300k, and that 300k was costing of equity, wasn't being used. It wasn't making you any money, right? But it was costing you £12,000 a year in mortgage payments, and you were using 100k of tax salary, right? So 40% given away to the government, and out of that 40k, you had 60k left, and that 60k left was paying you 12,000 over here, right? So he's using earned money to pay for tax-free money. In example 2, what we did is release the equity from the home. So we only had 50k of equity in the property now, but we had 5 properties. We now had 5 properties that were all going up in value, right? And were paying us, these 5 properties were paying us an income of £30,000 a year of tax-free money, because we're drawing against the director's loan account, right, of tax-free money. And even though our mortgage went up to 450k, so we had a bigger mortgage, the 450k was actually costing us £18,000 a year, was being paid for by the property income, which left us with £12,000 a year. So in example 2, we're using tax-free money to service debt on our property and making us a lot more money in the process. Now, if all of those 5 properties keep going up in value, we can refinance them and continue to grow the portfolio. If all we ever did was stay in our job with £100,000 a year salary and paid 40% taxes and paid down our own home, the best case scenario is we're going to be left in this example with a property that we own, that we live in, worth £500,000 equity. But by the time we leave our corporate job and we maybe end up with a pension, even if you were to end up with the biggest pension of £1 million, for example, like my dad did, paying you £40,000 a year, you're still not in as good a situation as if you were to leverage your money out and start to use your cash in a different way. And if you were to start to learn how to use your cash in this way and start to think about taxes and finance in a different way to what you think about them in today, you will build wealth. And this is the number one financial hack that I use and I teach within my program so that people can become wealthy. Everything in life has just got to do with your financial habits. It doesn't honestly matter how much money you keep. You can make £1 million how much money you make. It doesn't matter how much money you make. I was meant to say there, not keep. So it doesn't matter how much money you make, because you can make £1 million a year. But if you've got £1 million a year that you pay 50% tax on, you only keep $500,000 of it. And then if you've got £500,000 of expenses, because that's what your lifestyle is, that you're paying, I don't know, you may have kids and you're paying private school fees, that's expensive. Or you may go on lots of holidays a year, or you're paying down your mortgage because you live in a nice house. You're always going to be left in a situation where fundamentally you're not keeping what you earn, right? And it's never important how much money you make that's important. It's only important how much money you keep, and not the money you keep that you can multiply. And that's the true essence of how to build wealth. So I hope this made sense. I know it's a new concept and I know it might be confusing for a few people if you've heard this for the first time, but hopefully I've tried to make it as simple as possible for you to understand so that you can start thinking about money in a different way. If you like this video, give it a like. Please click the like button. If you haven't subscribed already, please subscribe to my channel and hit the bell icon. We produce content every week, and we help give insights, and we help you show how to build a multi-million pound property portfolio and how to use your money in a better way so that you can become financially independent. If you've got any questions, please just drop your questions in the comment section below. My team and I will go and answer them. I'm also going to create a free cheat sheet for this that kind of maps it out in a diagram for you. So if you want access to that PDF, just comment yes in the feed below, and my team and I will send you the cheat sheet that explains this and kind of gives you a kind of downloadable PDF that you can read through as well. So kind of like a mini 3 or 4 page ebook that you can read on equity release and how to use your finances in a better way. So I hope you enjoyed it. Even if you didn't enjoy it, I love you anyway. And go out there, be resilient, be great. I believe in you, and I'll see you soon.